Welcome, my name is Jonas Thulin, I'm Head of Asset Management here at Erik Penser Bank, and I will discuss our view on the market, what we've done, and the way we analyze the market going forward in this obviously very distorting and stressful times in terms of Russia's invasion of Ukraine. In this presentation we will focus strictly on the market, especially on the both FX but also the equity market, and leave all other aspects aside. So I hope you bear with me for that sort of starting ground. Now, in terms of the outbreak of war, we were fortunate enough to, before that, having had added a lot of positions in the portfolios that turned out to outperform quite aggressively on the day of the outbreak, the 24th of February, and also the 25th, and also now today on this Monday. Basically, our quantitative hedge strategy is doing a tremendous work of hedging all of the downside and adding on the upside. So on the day of the outbreak, we delivered 3% more than the benchmark, which is obviously a great day in the perspective of performance. Obviously, we don't feel great about it, but we have to sort of focus on the portfolio in this instance. Now, the other trick, as you can see here, that we have a huge US overweight, pretty much all of it. We have 2% in the Nordics. Just to keep a little bit of a Swedish krona, more for just being able to shift back if you think the Swedish krona will strengthen versus dollar. 92% of the portfolio is in unhedged US dollar position, which obviously is a great hedge going into this kind of environment. Since the 23rd of February, we haven't changed a single position. We think that we have some good positions here in the book. As you can see, cybersecurity, for example, did about 7.5% with FX on the outbreak of war and has continued to deliver since. So we don't really think we need to do something. European Bank, as it says here, please bear with us. That strategy is no longer with us, and it hasn't been since the 23rd of February. We can't really print on the slides what we're doing whilst we're doing it. So we're actually trading right now. I can't really comment on what we're trading, but European Bank is certainly not with us. So basically, we're hoping to give some good alpha this year as well. We're averaging about 6% per year, and we'll see how this year fares out. The situation in Ukraine obviously creates a lot of both political and personal stress. But leaving that aside, if we focus pure on the market, what we've done is that we have included Latin America, emerging markets, energy, through a sustainability lens, I should add, China, soft commodities, and also cash position. We also have downside protection in terms of hedges. Now, that means that when we enter this turmoil on the 24th and 25th, we were able to make quite aggressive positive returns. And not that we had bet on an invasion as such, it was more an effect of what happened in price inflation. And I will show that, which of course indirectly is linked, but I will show that later on. Right now we have to build a puzzle of the fundamental factors, which is macro and profit, still great. You have the Fed, they're still going to hike. And then you have what I call the Russian effects. And we have to sort of break this up in order to derive which one of these is actually driving the market, so we know what we're doing and when we're doing things. And this has actually become quite fine-tuned in the market right now. There are 3 contracts out there that we need to watch in order to understand how the market views risk. And I will show you where those things stand. If geopolitical risks and the risk ship fades, we still see a potential for growth equities. So we're keeping those. And obviously cybersecurity, cloud computing, etc. has a great stride. Anyways, the link between our portfolio and Russia is 0.6%. The link between us and Ukraine is less than 0.1%, so we pretty much try to close any kind of influence out of this equation as far as we can on pure equity basis. There are indirect links, especially through the financing channels following the sanctions, and I will come back to that. Now, we don't have to spend time on this, but this is really just to show the amount of geopolitical risk that's occurring in Ukraine. What will happen on the exports from Ukraine following the Crimea situation, annexation from Russia, and now we have an invasion from Russia. So obviously we have a sad outlook for Ukraine economy. And really for us, it's more of building a portfolio, how we're going to handle this, what can we hedge, what do we basically have to exit, etc. We do a similar mapping on Russia. Now from history, we don't know all that much. We know from armed conflict that on average the first day of armed conflict we lose 1.5%. When the London equity market closed on the day of the outbreak of this war, we were down 1.51%. So we're pretty much handling this as a historical average in that sense. Might sound very weird, but I think this is more of a sign that the market has virtually no idea of how to handle this. So the only playbook we have is history, so we're going to use history. Now, in terms of days to bottom and days to recovery, we don't plan our portfolio following this. This is more of this is the sort of the armed conflict we've had since 1941, 1940. So it's worth what it's worth. What we've done, as I said before, is to add emerging markets, China, Latin America, and we're keeping hedges on. Now, this is how the S&P 500 has developed so far in red, and compared to historical armed conflicts. As we can see, it's the equity market has a quite a tendency to handle armed conflicts quite, I shouldn't say well, but in that sense, quite constructively. I think what this picture hides is that there will be tremendous differences between regions, between different sectors, between different strategies. So the overall performance might be one thing, but I think there will be obvious winners and there will be obvious losers in this going forward. And our job is trying to find as many winners as possible, of course, and avoid as many losers as possible. Some might sound harsh and politically incorrect, but with all due respect, from an asset management point of view, that's sort of the brain, how we have to think this in terms of position taking, which is what I'm presenting here. Now, geopolitical risk is explaining about 90% of the equity market right now, which is a huge swing factor in January, which is what we're following, which is quite important for us. And we will believe there will be a driving theme going forward. What we saw, because there was a driving theme, is that all of a sudden S&P 500 started trading as if it was the same thing as the Ukrainian CDS. CDS have bankruptcy insurance price. Right now there's a likelihood of a 92% of a bankruptcy situation in Ukraine. It's about 56 for Russia. So things are happening here which are quite dramatically. You have a huge correlation effect versus the S&P 500. And really the question going forward from an asset management point of view is what's going to happen to these correlations and effects going forward. And I would try to derive our thinking in that. Now, we usually don't show too much of our actual position, but this is something that I think is important to show. It's our hedged position. Basically, our position now is in orange, which you can see here since March 2000. In the pandemic, it made about 36% on the upside. And obviously, when we walked through the events of last week, this is one of the positions. We also carried double the position size on this one. That actually delivered a strong return for us. And in terms of performance versus S&P 500, it has a positive trend, which means that the market is delivering better performance in terms of vol hedges than just keeping outright naked exposure to the indices. That means that even though we are slightly overweight on equity positions, we're actually, in terms of equity risk, we're underweighted. A bit complex, but I want to show this because it's quite important for us to see if this works. And hopefully we won't see this kind of vol blowout, but if we do, then it's time to take profit. What happened then on the Friday is that the correlation between the equity market and the CDSs broke down. And then all of a sudden the market was quite convinced it had to do with three factors. There's less chance of a Fed hike. We are too bearish. And the US was quite deliberate in how they communicated. This was a regional conflict, not a global conflict. As such, the S&P 500 could turn around, given the fact that that was sort of the sentiment indication that we saw. And I will come back to that as well. On this page, we don't have to go through this, but I'm trying to derive here that yes, we saw a little bit switch or tweak in the Fed fund futures that sort of gave that argument a little bit half right. We saw a bottoming trend in sentiment, giving that argument a little bit half right. We certainly saw a huge rebound in US growth and metrics, where US annual GDP growth last week, we saw data that increased the growth rate from 5 to 7.5%. So obviously there was something in all these three different arguments. Will they be enough to sort of break away the US S&P 500 in terms of global equity markets or European equity markets? We obviously don't know that yet. The way we have handled the risk is to have all our ships on this side of the table and very little on the Eurozone side, or actually nothing in the Eurozone side. So in terms of positioning, we'd certainly put the ships on this type of data. Now, why did we put on the hedges and why haven't we done anything after the war started? We put on the hedges because the short-term CPI was priced up quite aggressively before the invasion. Obviously, it's linked, but that move for us was a clear distinction that we need to do something about the risk in the portfolio. So we added emerging markets, LATAM, etc., and these downside hedges. Then actually on the day of the invasion, and since the 2-year break even has actually come down a bit. But this is really for us, this was the signal that I think we've spoken about in these presentations before, that the thing that would concern us was that the price inflation turned around and then we acted immediately. From a portfolio perspective, that was a good thing. Obviously, it's a huge human tragedy what's going on. But again, we're trying to stick to portfolios. Now, compared to January, when price inflation didn't move at all, that's why we then bought into that story. But this time it's completely different. So why haven't we gone further than what we've done in the portfolio? And the reason for that is that the medium-term outlook for inflation is still not coming up. It's still actually coming down. So it is as if the market see this as a short-term burst in inflation, not a long-term or medium-term outlook. So we have to deal it as such in the equity market as well. We can see that distinction quite clear if you compare the commodity market, pricing in more on upside on inflation, and if you look at the inflation swaps, more downside on inflation. So we have this kind of ambiguity of the markets in between themselves, and they're obviously going to work out in one way or the other, and we will stay tuned and follow basic allocations on top of that. The supply bottlenecks is of course still dissolving quite rapidly in the US, which means that we have shifted entirely our Fed fund futures curve to a much lower Fed fund futures because the inflation is pretty much withering away in front of our eyes. Now the war in Eastern Europe is obviously complicating this picture quite aggressively, which means we need to add one more layer in the analysis. So we have fundamentals and earnings, and then you have Fed, and now we have now we're adding Ukraine and Russia situation. Now it's important to remember that the Fed was already tilting to the dovish side, so we can use natural language processing in order to calculate if they're bullish or hawkish, I should say, or dovish. We're right now in a dovish camp, meaning that anything that comes up on the radar, which is a bit of a concern for the Fed, is going to be interpreted by the Fed as dovish. It's the completely different situation that we had in 2021 and 2020 when everything was hawkish. So now we have to turn the table. That means when the situation of Ukraine pops up, the invasion of Ukraine, I should say, we already know that that's going to be interpreted dovish from the Fed because they're already tilting dovishly. So the market's going to jump on that bandwagon immediately, and that's what happened on the Friday. I would say quite aggressively from the market, but still it sort of makes sense in the perspective that we already know that the Fed is going to be tilting towards the dovish camp. Now we also know that from the fact that the butterfly 2.5 is showing a rapidly lower 10-year yield with a peak inflation, and then sort of, I shouldn't say transitory inflation, but it's coming down in terms of the Fed, in terms of the rate curve. Now, financial conditions, that's probably what I want to end up with, because this is where things have become a bit more complex, but also quite more importantly, financial conditions are worsening in the US. They're already very bad in Europe. So obviously ECB won't hike this year, and then Riksbank won't hike this year. That's sort of already given. But the question now is, to what extent are the sanctions? We don't care too much about the effects on Russia, because we have no money left in Russia. And we, obviously from a personal perspective, human perspective, we hope that the sanctions will hit hard. But we're more interested from an asset management point of view to see the second round effects of those sanctions, what can actually be rebounded out in the economy. And basically, if you, for example, if we freeze all the and terminate all the leasing contracts on jets in Russia, and they're 63% of their fleet is leased, they won't be able to pay. So someone is sitting somewhere with a huge credit risk all of a sudden. And that's a naive, sort of simplistic way of putting a lot bigger issue that's on the table. And that can actually be tracked down to 3 different contracts. So we can see now financial conditioning are getting worse, but it's not due to funding rates because they're getting easier. It's not due to the rate instrument in terms of supply and quantitative tightening. If we have to go into the FX swaps, that's our first clue to understand, okay, well, FX swaps are a bit clumsy, so we can look into the FX basis instead. So when we're doing this math, we realize that something is happening in the FRA-OIS spread. The first move we can sort of say was caused by the Fed, the second by Russia and the sanctions on Russia. And this is really, it might look a bit naive, but it's just really where a lot of people in the market are now focusing, because it's a neat way to follow the stress the sanctions will have on a Western capital system. We don't care too much about Russia. That can sort of develop the way the politicians want it to develop. We totally agree with that. But we're more interested in the second round effects going into Europe. What would happen now, obviously, is that the central banks will come up with FX swap lines and give much more liquidity to the Western capital markets. But before that happens, we're going to see a little bit of squeeze going on here, and that's why futures are down in US, etc. So if we take the FRA-OIS spread and put it into our daily trading model, you can see it right here. We can see a downside today, and that's obviously built on that we see this stress, the second round effects from the sanctions. We will not turn more bullish or constructively optimistic until this stress is leaving us. This is the sort of trick we played around in the pandemic, just to wait so we can see this financial stress being solved. It probably won't be solved until the central banks is pushing out liquidity. If they do, don't forget that the spread between today's spot level in S&P 500 and the aggregated target for S&P 500 is quite big. It was quite big in 2018-19, quite big after the pandemic, and it's quite big right now, which means that the potential for a snapback in the equity market is quite big when we talk about US equity markets. You also have a situation where the margin debt has been cleared out, or the momentum is completely stopped, I should say, which means that if the institutions start to put up leverage positions again in order to catch up to the year-end forecast on S&P 500, that could be a quite dramatically interesting journey to keep an eye on. Now, obviously, now I'm talking about the US equity market, but we're not at all as constructively bullish on European. Now, in order to look at sentiment, and I saw that we saw a trough in sentiment, don't forget that we don't look at sentiment in terms of bullish, bearish, all this kind of market sentiment indicators out there, because they're autocorrelated pretty much with the equity markets. So what we like to look at is this kind of Twitter sentiment, which we were able to construct a model that is actually leading the actual sentiment, and you can see by yourselves the downturn, also the rebound effect that we saw after the invasion. So there's a lot of things happening now, both on the way we study Fed, but also the way we study equity sentiment, which is quite interesting to look at. Now, in terms of earnings revisions, everything is, I shouldn't say great, but it's still positive. We don't see negative downturns on that. So in terms of the business cycle versus equities, it's still a strong business cycle. But we need to combine the strong business cycle with the earnings outlook, which is still strong. With the Fed, they're still going to hike, but less so than we thought a week ago. And driving the entire agenda is then the stress in the financial system following the much needed sanctions that we obviously 100% support, but our job is to try to derive and calculate the second round effects of those sanctions in the system. And as I said, it might sound a bit weird, but there are basically 3 contracts you need to look at in order to capture this. And they're the ones that I just shown you, and they're tightening today, Monday. And the futures are all correspondingly down as well, dollar up, so the portfolio works. but going forward, I think those three matrices are key. So we're probably going to be back as we were in March 2020 to this daily trading model to see when do we see a solid pickup in this model, which would indicate easing liquidity concerns in the equity market. And hopefully then we could come back to trade macro profits, etc. Now, I know that sounds a bit naive given all the terrible things that are going on in the world, but we have also shielded ourselves by not owning anything left in the Eurozone, and we're actually selling off some of our Nordic exposure. So we are slowly but surely, I mean, we have completely left the Eurozone exposure, and we're trying to handle that from a portfolio perspective as best as we can. So with that, I'll leave you, and I'll be back in a week with an update. And thanks so much for your time.